So we're going to look at EA Sports, and in this video we're going to go through the process of valuing a company. And the way we do that is we enter financial information into the model, and then we calculate the future free cash flows of the company. We discount those cash flows back to today's dollars using the appropriate discount rate. And then we'll have the intrinsic stock price, and we'll be able to compare it to the actual stock price to see if it's a buy or a sell. Then at the end, we're going to look at financial ratios and compare them to a competitor. So first, let's get the market cap for EA Sports. 34.5 billion. The stock price is 119.51. Okay, and next we're gonna get the free cash flows. So we'll go to Yahoo Finance and go to the cash flow section and then pull 4 years of free cash flow. And you want this number to be positive, because if it's not positive, then they're spending more cash than they're bringing in. Next we're gonna get net income, and that's on the income statement. And we'll pull 4 years of net income. And some people call net income profit and loss. Last, we'll take the revenue, which is just the sales for a given year. Now we need to look at the capital structure of EA Sports to see what the discount rate we need to apply to the cash flows. So they pay $42 million a year on their debt. And let's see how much debt they have. Current debt is $600 million. That's debt due within 12 months. Long-term debt of $397 million. That's debt due after 12 months. So they have more current debt, but fortunately, they only have 3% of debt in their capital structure, so it doesn't seem like it's much of an issue. We need to find the effective tax rate since interest payments are tax deductible. Information. So the income before tax is $1.5 billion, and the income tax paid is $406 million. So they have a 28% tax rate. So even though they pay 4.2% interest on the debt, it only cost them 3%. And now we need the cost of equity, and to do that we need the beta, which is the volatility of the stock. And they have a low beta, 0.93. So a beta of 1 just means the stock moves with the market. And this has about a beta of 1. So when the market goes up 1%, this stock goes up about 1%. And the weighted average cost of capital is a blend of the cost of equity and the cost of debt, and that's 9.28%. And that's what we're going to discount the future cash flows by. And that's the number this company uses to make investment decisions. Their WACC. So we estimated the future free cash flows for 4 years. Then we did a terminal value, which is all years past year 4. And we discounted those numbers back to today's value, and we get a value of the company of $29.9 billion. When we divide that by 289 million shares, we get a stock price of 104. It's trading at 120, so it's trading pretty close to intrinsic value. So according to the model, it's a sell. It's trading at a 15% premium. Now let's look at the historical stock price. So it's been kind of flat for a while, around 100 to 120 in that range for a decent amount of time. It looks like it was as high as maybe 150 or 140 at one point, but that didn't last too long. So it's been trading close to intrinsic value. Let's look at the financial ratios of the company and see how they stand up. So we need some more information from the balance sheet. So we need the current assets. That's $6.5 billion. And now the current liabilities, which is $2.7 billion. The equity, which is $7.5 billion. And the EBIT, the earnings before interest and taxes. So current assets is cash, accounts receivable, and inventory, and that's assets that can be easily converted to cash. Current liabilities is short-term debt or accounts payable. And equity is the value of your firm according to the balance sheet. It's total assets minus total liabilities. Earnings before interest and taxes is just your operating income, which is your revenue minus your cost of goods sold. And it's good. It seems like they have pretty healthy numbers. So let's look at the ratios. PE, price over earnings per share, and under 15 is generally a good value. They have 11.4, so that's a really good sign. Price over sales, that's a little high. I usually look for 2.2 below. That's stock price over sales per share. So since they have a good PE, I can handle not such a great price to sales ratio. Price to book, I like to see 3.3 or below. Current ratio, I like to see between 1.2 and 2. And they have a great return on equity. So that means the company is doing a lot with the equity financing that they received. They're providing great value to its investors. A much better PE, not even close. They both don't have great price to sales ratios. Price to book is, they're both okay, pretty much the same. The current ratios are fine for both. But the ROE is so much better with EA than it is with Zynga. But Zynga is a newer company, so that could be a reason why they might not have such a great return on equity. It could just take them time. And both have low debt, so that's not an issue. And I also added this probability of default calculation, and they have 0 probability of default. So that's a good sign also. So I hope you like the analysis. Let me know in the comments if you want me to do another video, and thanks for watching.